Hello and welcome to our latest urgent market update brought to you by the live trade room. Now today is Wednesday the 4th of October 2023, of course, and the topic behind this particular video, you're probably very familiar. We've had some very significant bearish moves in these markets, and we'll go through the charts in just a second to explain things in a little bit more detail. But we do want to underline perhaps some of the major reasons why we've had such a bearish move in the last couple of weeks specifically. And more importantly, will it continue? So we've been able to benefit from some really profitable trades over the last few weeks. The first 3 weeks of September was a little bit sideways moving, a little bit inactive, a difficult trading period. We were expecting a little bit of an explosive move, but there was a couple of very, very important key events in the last 2 weeks specifically, which I want to draw your attention to over the course of this video, just so that you as a trader are knowledgeable and have a degree of understanding in terms of not just what's happening, but try to give you a little bit of context in terms of why it's happening. And like I said, more importantly, will it continue? It's going to be an important discussion point. So on that note, let's get into this video. Okay, so the first thing we need to put up on screen is our risk warning. Take a brief moment to familiarize yourself with our risk warning. So feel free to pause the video if you need. Okay, so let's get straight into it then. Let me start off by bringing up this news event. And we need to go back to Wednesday, the 20th of September. I want to explain to you what these markets were doing prior to that particular event. To do that, we'll have a look at the S&P 500. We'll have a focus on this particular market. And if we look at the monthly time frame first, you can see the highs from July and August, arguably, we're really just a couple of hundred points away from, just under a couple of hundred points away from all-time highs. And if you understand the backdrop, we nearly had a banking crisis in March. We've had these markets largely rally off the back of an expectation for the Fed to pivot their monetary policy, interest rate hikes. There's been this expectation that the Fed would actually pivot a lot earlier. And also we've had sort of this AI stock mania really for the first half of the year, which has driven valuations excessively higher. And you'll probably be very mindful is the vast majority of this move in the first 6 months of the year was very much driven by 7 to 8 tech-related private companies and their valuations just absolutely exploding. So we've had these drivers driving these stock market prices higher. We've also have had fairly positive data coming out of the US. Corporate earnings have been holding up quite nicely, and a lot of the sort of macroeconomic indicators have been coming out showing that the US economy is still pretty strong at this point with a fairly strong consumer. So since August, we've had a little bit of a downside move, and in the latter part of September, and this is where we're really getting to, I want to draw your attention to this particular price action here. For the first part of September, we really didn't make that much progress at all. We were kind of very much range bound. However, something happened at this particular point in here, and that's what I want to draw your attention to. That's when we started to see these markets move in a very significant manner, which we're still dealing with today. So that takes me back to Wednesday, September the 20th, and we were trading comfortably. If I get out just be a little bit more accurate. So this coincides, this candlestick here coincides with the 20th of September. So we're only talking about 2 weeks today. And we saw highs in this market of the 44.61. So we were still at the lower end of this little trend line. But when we take this news event into account, this FOMC So what happened? Well, it was 7 p.m. The markets were fully expecting the Fed to pause. That's the first thing. And we did get that pause. As you can see, the markets were very much pricing in 5.5%, and that's exactly what the Fed decided upon. There was a little bit of conflict in that decision. However, it was decided, yes, we will keep rates on hold at 5.5. But this is where things differ. This is where the Fed are hawkish in nature, whereas many other central banks are a little bit more dovish in nature. So you have this differential between a hawkish central bank, meaning rates are likely to go higher, versus a dovish central bank, which implies that rates at some point will start rolling over to the downside. So this is when the markets suddenly realized that the Fed are actually genuinely interested in keeping rates higher for longer. And as a result, these markets started to discount. Plus, we had the statement and the press conference from Jerome Powell, and he reiterated the need for rates not just to potentially go higher, but to stay higher for longer. That was a key theme to being able to bring down inflation on a sustainable basis over the longer term. The last thing, I suppose, the central bank wants is to give an opportunity for inflation to actually spike higher, and the Fed need to go through another round of rate hikes, which we've seen in the late 70s, early 80s. So they're trying to protect against that. However, they are probably fully aware that these rate hikes are likely to cause a financial accident of some kind. Now, none of us know what that accident could be. In March, it was looking like it was the US banking system. Then the authorities stepped in to put a bit of a floor under that, and we've kind of grown out of that, and it's been almost a little bit of a positive response to that particular development. So this was when these markets broke out of resistance and the prices started to correct that fundamental view that actually the Fed are likely to keep rates higher for longer. Now that has a pretty significant impact across for governments. It has an impact across the corporate sector. It has a massive impact on individual households and income. So with this cost of living crisis, we're seeing wages sort of push higher as well. That is inherently inflationary, and therefore the Fed have a primary focus on unemployment, looking to see unemployment increase. They're looking to see, they know that these higher rates are likely to impact growth, so they're probably awaiting slightly softer growth outlook, although so far, year to date, the growth implications are pretty strong. And the third sort of pillar is inflation. So they're really trying to push these rates higher so that they keep the pressure on this inflation story and it keeps reducing. And just something to keep in mind, just a figure at the forefront of your mind, that these central banks their primary remit is employment, but also keeping inflation under control. And the target for inflation is a kind of an arbitrary target, but it's 2%. And that's where they want to get to. So we currently have inflation in the US at 3.7. It's spiked, it's kind of bounced off the 3% mark, which was quite close, obviously, to 2%. So now it's kind of looking as if it's a bit stubborn. And that 3.7 level is nearly twice what the target actually is. And this is why the Fed are under a bit of pressure to make sure they keep those rates higher for longer. So when we look at these financial markets, we're anticipating this is kind of a bit of a corrective move. They're trying to price in that fundamental principle that the Fed are going to be holding rates higher for longer. The other area of these markets where it's quite easy to see that this is the case is through the bond yields. So if we have a look at 10-year, and we'll have a look at compare and contrast against the 2-year, what you can see down here, bottom right-hand corner, is the 10-year. So we've had an exponential move from 4.2 up to 4.8, let's say. We were just up at those levels just a little while ago. So that's an exponential move to the upside on the longer-term yield curve. So committing your money over a 10-year period would actually get you significantly higher yield than obviously than we would have seen a few months back. Now, in contrast, we've not seen such an exponential move in the shorter term yields. So it is looking as if these yields could stay higher for longer, which is feeding into that whole sort of interest rate outlook that we might need to be around 5.5%, maybe as much as 6%. JP Morgan are suggesting that the economy could cope with 7%. So there's a lot of conflict really in terms of what the Fed are likely to do. And to be fair to the Fed, they have mentioned the fact that they're going to be data dependent. So it means that things like inflation numbers are going to become really, really important. This week, we've got job numbers coming up. So all of these features are going to play really, really heavily. And then we'll have the growth related indicators as well. And it'll really show us where we are. So we've had significant bearish moves. The reason for that is very much just market pricing in this higher rate for longer narrative. And I'll explain to you in a second what that brings about. In fact, I might bring it up now because it's worth noting that if we have, and we've been talking about this for the last 2 years, if we have a hawkish Fed, what we'd be looking for is inflation to remain somewhat sticky. And I think that's fair enough above 2%. It would come down an awful lot from 9% down to 3%. So that we've seen some massive improvements, but we're still not at target. So we've got this higher rates environment due to sticky or perhaps higher than expected inflation. And as a result, we can expect markets like the S&P 500 to sell off. We've got this risk-off narrative. US indices selling off, not just in the US, but also in Europe and Asia as well. We've been looking and trading quite successfully this dollar higher narrative as well. So we've been heavily exposed to this dollar strength trade along with the indices to the downside. We're constantly monitoring these US bond yields and they're continuing to accelerate to the upside. And we've seen recently some very, very big moves in markets like gold to the downside on the commodity side of things, and a little bit of softening in US oil as well. So these are the narratives that are playing out. This is really effectively what we're seeing. We're seeing strong momentum to the downside for the equity markets. And I'll just share with you the euro dollar, same kind of narrative, dollar strength. We're seeing a nice little bounce off these lows, but you can see the nature of the direction of this trade and this market over the last 2.5 months is very much bearish. We were drifting sideways for about 5 months, and now that sideways move is now turning bearish. So really further downside for us. Is there any, the second part of the question is, will this bearish move continue? Now, we really do think it will, because we don't really have conditions for anything significant to change just yet. Now, there's a few things in the pipeline that could change the picture quite considerably. We could have a change of emphasis from the Fed. They could start saying, well, actually, I think we're now high enough. We might start looking at pausing for a while and perhaps even turning quite dovish pretty soon. That would be a pretty significant change for these markets. Also, we're going to be, we've got corporate earnings coming through in the next week or two. And if they are still performing exponentially well and performing, and there's a general positivity behind those earnings numbers, then it does create a bit of a conflict for these markets. But as things certainly stand, there's still this restructuring, there's this repricing, bearing in mind the Fed are actually coming through with what they were talking about, and the market is now realizing actually it looks like these rates are going to stay higher for longer. So we're going to see. And the other thing as well, with these higher rates, we could have a financial crisis in the pipeline, and that would significantly change the picture as well and potentially turn the central bank, the Fed, quite dovish very, very quickly. So there is elements that can shift, but for now, we're looking to just go with this market momentum. It's very bearish. We do think it's likely to continue over the course of the rest of the calendar month, but we'll be, like the Fed, we'll be monitoring this data very, very carefully indeed, and trying to sort of navigate and capitalize on continuing bearish moves, but also potentially that kind of turnaround narrative where we get a bit of a dovish Fed coming through. We either get this kind of soft landing principle where this economic data remains really quite positive in the face of higher interest rates, meaning it can probably cope with higher rates. And that would bring about a bit of a risk-on environment. Indices could easily turn higher. The dollar could start to roll over to the downside. And although we're on this narrative on the right-hand side of the screen right now, that could very, very quickly change. And when it does, we can also change our views on these trades. Okay, so that's kind of a long-winded explanation, really, in terms of where we're at, why these markets are doing what they're doing, and more importantly, will they continue? And we think short-term, yes, that's how we're positioning ourselves for further downside across many of these markets until something significant changes, and that's the key. Okay, then, guys, you may have further questions off the back of this particular video. If you do feel free to email us at support@thelivetaderoom.com. We'd be happy to get back to you as soon as we possibly can to answer all the questions that you have. And we'll, of course, see you live as well in our live trade rooms if you're able to join us. So all that's left for me to do now is to thank you very much for joining us. Do stay tuned for our next video. And just to let you know, we do trade these markets fully live and interactive every single day. We're trading. We have our pre-market trade plan at 7:30 a.m. every single morning, where we do our trade plan, where we do all our analysis and identify exactly what we're looking to trade and the direction which we're looking to trade these markets. And then we're broadcasting from 8 a.m. for the European trading session, and we're back again at lunchtime for the US trading open, the cash open in the US. We often get very significant moves around these particular times of the day that allows us to kind of strategize and allows us to get into those trades early. So for more information, just go to thelivetraderoom.com and do feel free to connect with us through our website if you need. So on that note, thanks so much for joining us. Do stay tuned for our next video. We'll see you soon. Bye for now.